Yes, good afternoon to everybody. Over 30 wonderful people right now on the live today to discuss stochastic oscillator and how we use it for, trading reversals in the market. But as usual, Emmanuel will not, just give you who can sync up what an indicator is or what it does, and just say, okay, do it this way or do it that way. As usual, we're going to explain the rationality behind it and how we can make it function better than what has already been established for that particular indicator already. Remember that, as I will always say, that every indicator or every tool can only work better when you had the human factor. Without the human factor, you are going to limit the functionality of those tools in the market. So it will not be enough for us to just, on a normal pedestal, talk about stochastic oscillator and how to use it for price reversals in the market, but rather talk about the idea behind stock itself, some of its uses, some of its time frame divergences, and how we can also use it to spot reversals in the market. If you already know what RSI is, you are not going to have any problem with what stock is as well. Stock is majorly a momentum indicator, right? It helps us to, gauge the momentum with buyers and sellers in the market. Like I would always say, that every single chart that we have in the market shows the activities of buyers and sellers, right? As we know it to be, it means every time we have a chart, we understand that that chart shows how buyers are relating with sellers and how sellers are relating with buyers. And, you must also understand that in as much as these guys are relating with themselves, right, we also understand that it's not possible for both sides to make money at the same time. One side will lose for the other side to win, or one side will lose for the other side to win. So for that reason, to a certain extent, we do understand that both parties will always have a say on the chart. No matter how strong a move is, after a while of buying, there will still be some period of selling. And after a period of selling, there will still be a period of buying. Right. And how the momentum shifts from one side to the other, how we know that buyers is about to step in, or how we know that sellers are about to step in, is naturally through market information, through what we know about the instruments, through market analysis, strong and weak currencies, weak and strong currencies, as the case may be. But also, to a certain extent, it's possible you don't have ready-made information about which party is currently in charge or what party is currently taking control of the chart, even though a chart will naturally show it by visuals. If you see prices consistently moving lower, we clearly see, oh, it means sellers are in charge. But if we see prices consistently moving higher, we say, okay, in this case, buyers seemingly are in charge, right? But to a certain extent, like I said, power changes hands. It means, to a certain extent, sometimes buyers would have to relinquish, whatever control they have to sellers. And also at some point, sellers would also have to relinquish, whatever control they have to buyers. It means, to a certain extent, there are two things that we can majorly do or use the stock to do in the market. And it is through, trading alongside the trend continuation, or, for example, sorry, we can use it not maybe not for trend, but for trade continuation. We could also sometimes use it for trade reversals. It means, for example, if to a certain extent I have understanding about who I think is in charge of the market, if I think buyers are currently, in charge of a particular asset, or if I think sellers are currently in charge of a particular asset, right, I can use stock as one of my major tools for confirmation that I can keep trading in that particular respect, or if I need to hold on or not. And also, on the other side, I could also use it to understand if I need to switch my attention from buying to selling, or from selling back to buying. So, like I said, it can be for either trade continuations in line with what you already perceive about a particular market, or it could be in line with maybe you need to alter your trade direction in terms of reversals. And for today, we want to focus majorly on the reversal aspect, but also at the same time, we'll try as much as possible to balance it out also with the place of how to use it for continuations in the market. And like I said, stock majorly measures the overall strength of buyers, of buying, sorry, not necessarily buyers, of buying or selling momentum on the chart. Listen, I don't want to complicate it. For example, if you go online now and you go and check what oscillators is or what stochastic oscillator is now, it will tell you some history, some things that you don't, necessarily need to know about the asset. For example, it will tell you, oh, it's used to measure or compare the closing of a price to the opening of a price to determine momentum. This, listen. All of that is mathematical. We don't care about mathematics here. What we bother with here is the interpretation of this thing and how we can begin to make sense when you start applying it to your trading activities. And the major thing here is that it measures the overall strength of either a buying or selling momentum in the market. For example, we can clearly see, a strength selling activity right here. To a certain extent, we can use stochastic oscillator to measure the current strength to know if we can still take advantage or if a reversal is coming at any point in time. So we don't necessarily, want to put so much English to it. And in fact, you can even further simplify it to saying it shows the strength. It shows you how strong or weak a buying or selling momentum is in the market. It means to a certain point now, we can make a logical conclusion that if you're really going to enjoy the activities of a stock, there must actually be a momentum in a particular direction. It means a ranging market overall might not be perfect for stock, even though if you put stock on a ranging market, it won't reject it. Which is where I'm saying that we're not just going to teach the facial aspect or the face value. We're going to go deeper into really understanding it. If its overall job is to show you how strong or how weak a buying or selling momentum is in the market, it means there must be a momentum, right? There must be a momentum in a particular direction, either up or down. So if I find a ranging market on a particular asset, it's probably not going to be the best to go and call stock in that particular regard. Do you get what I'm saying? It's probably not going to be best to go and call Stoke and say, Stoke, come and tell me something about how strong or how weak the momentum of this range is. It's not majorly created for ranges. It was created majorly for measuring the strength or the weakness of a momentum in the market, which is quite similar to that of the average directional movement index. The only difference is this one still offers more or less like a bullish or selling signal in the market, whereas ADX only tells you how strong or how weak a trend is in the market. So this is a little bit more advanced to a certain extent compared to what the ADX can do for you. So like I said, one more time, it shows how strong or how weak a bullish momentum is or a bearish momentum is in the market. And in this case, like I said it works with, very similar with what you know about, the RSI. The RSI is also an oscillator that also measures, strength or weakness of trends in the market. And it does this, through a formula which we don't care about, but it produces two things, two major demarcations, an overbought region and an oversold region. So yes, I know. It's similar to RSI. It also brings, typically overbought and oversold. I know, I know. It looks like, oh, are they talking about RSI? But it's deeper than that. But yes, it produces two major demarcations, an overbought region and an oversold region. Right? An overbought region, from the way it sounds, is when market has bought for so long, and the oscillator is saying, listen, this buying has been going on for too long. It has now gotten to a point where it's possible, there's a possibility that we might see a change in market direction. Now, overbought doesn't necessarily mean prices are too high, so sell. No. Oversold also does not mean that prices are too low, so buy. No. The problem with people using oscillators is when you were taught just overbought, oversold, that when a market is overbought, it simply means, oh, market is too high and eventually price needs to come down. Or when it is overbought, so oversold rather, it means prices are too low and market needs, to go back up. Listen to this. The reason why I'm saying no is because there's a catch. And what's the catch here? The reason why overbought does not necessarily mean you should go and sell, or oversold does not necessarily mean you should go and buy is number one. The catch is the momentum or the market movement might have a recent slash strong backing or catalyst. There might be, something that is really pushing the market in that particular direction, and it is so recent that the market might not be ready to sell or to fall back. We've seen it in gold prices over a period of time. Market has been oversold, 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 but still, it does not necessarily mean you start selling. The catch also is the overbought, oversold might also just mean expect retracement. Sometimes, sometimes the overbought or oversold nature on the stock is not saying, oh, yeah, go and sell, or oh, yeah, go and buy this particular asset, as the case may be, just because the market is now in overbought region. It simply means we are going to just go and take a sell, or because it is an overbought region, we're just going to go and take it buy. It does not necessarily mean that. Sometimes it might just be telling you expect some elements of retracement. That might be the entire thing it is saying. It might just tell you, listen, the market is so high, wait for it to come back lower, before you eventually get in, to this particular, market. The overbought, oversold nature on the stock does not necessarily mean buy or sell. Sometimes it might just also mean expect retracement. Are we together? So the catch is, we're not saying once we see an overbought or when we see an oversold on, stock, we just go ahead to buy, we just go ahead to sell. It goes deeper than that. In fact, we do analysis on stock, which means if you see your analysis of trend lines, your analysis of support and resistance, we even still do such things even on stock, which is why I said to this topic, I'm not teaching face value. I always like to teach, the functionality, the inner nature of that particular instrument. This is just the introduction. right? So yes, like we said, as we've established now, majorly measures, the overall strength of a momentum in the market, which means necessarily it works better on market that have, movements in a strong direction, either up or down. It might not be that functional on a ranging market. And like Stochastic says, I said it produces two demarcations, one talking about being overbought and one talking about being oversold. And like I said, that does not necessarily mean if it is overbought, you need to sell, or if it is oversold, you need to buy. Not necessarily. Rather, there might be some catches that you need to hold on to. Number one, there might be a strong or recent backing that is pushing prices in that particular direction. It's not going to go back. Number two, those overbought or oversold nature of the market might simply also be retracements. Now, when it comes, before we go further into some other things that we need to understand about this asset. Let me just pull it up quickly, and explain some things before we now explain some functionality about how we use it, and conduct analysis on it in the market. If you go to insert on your system, by the way, you cannot see insert on the phone. On the phone, you have to click on F. There's an F that's just like F of X in terms of mathematics, just like an F, or some of you can see that F of X or something like that, maybe on HFF or something. But F, majorly MT4, MT5 is to be F, right? If you click on it, go to indicators. Under indicators, just come down under oscillators. You'll find it there, stochastic oscillator. For system, we go to insert, we go to indicators, and under oscillators, we find it there. And this is stochastic oscillator. Now, I want to say there are three things that I want to explain here. The K period, the D period, and the slowing number. Now, what does these three things mean? Now, the first thing you need to understand here is, like I said, we're not here to do mathematics. So I don't need to start explaining how, they made or the calculation behind this. But the point here is this. This percentage K period is asking you to specify what period you want the oscillator to calculate for, like the general period of calculation, the main measurement of momentum. It is to say how many of the closing prices do we have together before we generate this figure. Like, I don't want to go into the entire, coding point, but I'm just going to read out this for you. The percentage K line is simply the main raw measurement of momentum, whereas that of the D is a smoothed moving average. So this one measures the momentum, which is percentage K. The percentage D is a smoothing out moving average, which is also sometimes called the signal line. Now, like I said, I don't want to go into calculation, but these are some of the things that I need you to have with you in terms of specifications and how we use it. I've taken the extra step to answer some further questions that you might have, especially when it comes to using it in the market. And like I said, I don't like face value teaching. I like thorough teaching in the sense where if you're going to be using it on a lower time frame, which means if you're looking for something, between M1 to M5 or M15, as the case may be, if you're going to be within this particular bracket, we use a standard practice of 14 for your percentage K period. We use 3. No, we use 5 rather, 5. And then the slow, we use 5. So we use 14.55 if you're going to be trading lower time frame M1 to M15, which means this will be 14, this will be 5 here. And this will also be 5. If you're planning to use it on a lower time frame, say M1, M5, or M15, as the case may be. Are we together? If you're going to be staying somewhere around the medium time frame, the middle point, to a certain extent, you want to use either M30, to somewhere around H4, at maximum H4, you need something around 14.33, which means this becomes 14. This one is 3, and this is also 3. Okay, if you're using it on M30, H1, H4, those 3 points, we majorly use 14.33. And that means if you want to use it to scalp, for example, okay, there's also one more here. Let me add one more here. Apparently, there's one more, via research suggesting that for scalping, lower time frames, you can either use 14.55 or you use another recommended one, which is 21.99. So if you're going to be using it to scalp, trading lower time frame, either you use 14.55 or you use 21.99. Okay. If you're going to be doing medium term time frame, M30, H1, at most H4, you need somewhere around 14.33, which is the major one there. If you're using it for higher time frame trading, in the market, either swing or you're looking to position hold, well, apparently the market wants you to stay somewhere around 933. Yeah. 933 if you're on higher time frames like dailies, the weekly, the monthlies. If you're on a medium time frame like M30, H1, H4, 1433 works for you. If you're on a lower time frame, either 1455 or 2199. Apparently, 2199 is better on the lower time frame. Okay, 2199 is said to be better on the lower time frame rather than 1499. But the 1499 can be used, but apparently they want this majorly for lower time frame as being best. 1433 is said to be best for medium time frame, and then 933 is said to be best for the high time frame. Okay, the 1433 is said to be the best for I hope you have this. Just keep it somewhere so that you can always know the coding for what it is, on the board. But because currently on 30 minutes time frame, and this is Euro USD, I can spot a downtrend. That's why I think I can use it on this, right? I can spot a very, very interesting downtrend on this particular asset. And I want to see what Stoke has to say, about this particular asset currently right now. How strong is this particular downtrend? Or is it starting to weaken on the board? Have we gotten to oversold? Or where are we right now on this particular asset? Or what other deductions do I need to also make about this particular instrument as we go by? Can we go? All right, let's do it. Okay, so we have our screen on the board, and this is the Stoke now. Here, you have an 80 line. The 80 line and above is what we call an overbought, but you can see that in this case, it is not functioning as an overbought. Because, for example, it's a downtrend. So the way we are going to interpret this overbought is not going to be in the place of saying, the market has bought it for too long. Because it is within a downtrend. It is within a downtrend. It's probably saying in line with you expecting retracement. Maybe, for example, you know that the market is selling Euro USD majorly because of, like I mentioned it this morning on Take on the VTF and also yesterday, because of political uncertainties in France right now. Prime Minister resigned. There are calls for, what's he called? Also the President, Macron, to also give up his position. Watch out something. If you watch out for all of these points right here under overbought, there are zones where exactly the market finished whatever retracement it was doing, and eventually prices continued to move lower. Look at this. Look at this. Look at something somewhere around here. Even this point here, where market get back to this region was also a point where prices continue to move lower. Even this highest point here was just simply the market retracing back here and the market continuing its move lower. So in this case, the word overbought in this particular context did not mean that the market was buying for too long. It was simply saying that whatever buying was happening at the time, the momentum is already dying. Because in this case, it follows the fact that market is buying, but then it bought into an overbought region. But we're not saying that, oh, the market was buying too much before. No, we're saying in this particular case, whatever buy is happening, the strength is weakening. Remember that when we define what this guy majorly does, we went away from whatever mathematics is all about to saying it just measures the overall strength of a particular momentum, either buying or selling. So at the time, whatever buying was happening somewhere around here, the strength had already exhausted itself. I know I am supposed to sell Euro USD because of the current story that I have. And fortunately for me, I am seeing stock get into overbought region. That's a confluence for me to continue to trade in the right direction. Remember that I said two things about stock. Number one, trade continuation, and number two, trade reversals. So in this particular environment, they were acting as trade continuation signals for you right here, saying whatever upsides you're seeing right now, it's already getting exhausted. The market should continue to move in line with what you already understand about this asset, which is downside majorly because of what? Political uncertainty in the euro area. Like I said, tools don't work in isolation. They only work better when you had the human factor. I keep saying it. Emmanuel will never teach a trading indicator as if I'm only trading the indicator itself. That human factor must come. It must also, you must add something about the market that you know, something about the original trend or the movement of prices that you have an idea of as well in the market. Are we together? So in this particular respect, the word overbought or oversold on the stock does not necessarily mean that, once it's overbought, it simply means you should come and start selling. Or once it is oversold, it simply means you should come and buy. I told you there are some catches, but to a certain extent, the context also determines how you use it. There's a downtrend, stock is showing you overbought. It's showing you that whatever element of retracement is currently happening, the strength is already reducing. It's probably time for sellers to step in. Oh, the market is currently on, an uptrend, but market is currently going down, or stock is currently inside oversold. It's also telling you that currently, whatever elements of retracement you're seeing is also weakening, as the case may be. But you should also pay attention to two things. Two things. That can help you with using the stock for trade continuations. Now, not trade reversals, right? Trade continuations. But for me to do that, pay attention to the two things that we have on this board. We have a broken line right here, and we have a steady line. In case you want to know what those lines are, you can ask indicator itself, properties, and go to colors. And you can see that the main line for this particular stock right here is green. This one is the major one following the market chart, right? The green line is the one following the chart in terms of overbought, oversold, as the case may be. But there is another one there called signal. It is that one that offers if it is time for you to buy, or if you can consider the buy, or if you can consider the sell. So the reason why there are two colorings here of different nature is one is the overall main, graph that follows the chart. The other one is the one that traders uses to determine if it is time for them to buy, if it is time for them to sell. And that, in that particular respect, it's not compulsory that one is normal and one is thin. For example, you can change it. You can make both of them thin, like the same, and change just the thickness. So I can make the signal one very thick and make this one not that thick. You understand? So if I do it this way, oh, this is not good. Let me make one of them. This is not easy on the eyes. Let me see. How can let me see. What if this goes down and this one goes up? I think we should just maintain the broken line then. Let's maintain the broken line. Let's maintain one as broken line. I think that's why they put it there, so that it does not conflict one another. Let's make this a broken line. I think it was this one that they used. Let's just make this one a little bit thicker so that they are not that close. Okay. Yeah. So it's fine. Whichever way you want your own is fine. But I'm using the main one as the one that follows the main chart, and the broken one as the one that it is called the signal line. Then how does this work? It works through what we call a crossover. Now, we have what we call a stochastic crossover. Now, in this particular case, what are we looking for? Sorry, guys. Buying or selling in line with current trend using the stock. The idea is if the main line crosses above the signal line, that's a bullish signal. If the main line crosses below the signal line, that is when it becomes bearish. Which means, for example, and listen to this, like I said, we need to rationalize it. It says if the main line goes above the signal line, it's a bullish signal. But if the main line goes below the signal line, it's the bearish signal. The question would be, first, what did you intend to do on that particular asset? Because if you go ahead, opening every single chart you see, and you just want to see, if main line goes above the signal line, I will just buy. Or if main line goes above the signal line, below the signal, I will just say, That's not the best way to use it. If you're going to use it on face value like that, just simply based on rules, you're just there coming to see. So as the signal line gone, as the main line gone above the signal line, or has the main line gone below the signal line, that's not what we do. Let me show you what we do. This is the best way to do it. So say, for example, this is a seller's market. This is a seller's market. So you intend to sell because, Euro has some internal troubles. With political uncertainty in France. Now, so we already have the idea of what we want to do with Euro US. We want to sell. No debate. When we get to what's it called? The stochastic, we want to see where the market momentum is right now. either overbought or oversold. But considering the fact that whatever overbought or oversold where we are seeing is probably going to be for entry or for exit in this case of your direction. Listen to this. It is going to be for entry or for exit of your direction. It means because I have made my decision, my entry for a sell would come from oversold region on the stock, and I would be looking to exit the trade when it approaches oversold. Sorry, this one will be overbought rather. Overbought here. The other one is oversold. See what I've just said? That my entry for a sell, because I did not come here to buy. It's a different case if I did not know what I was going to do and I just needed the stock to tell me what to do. That one, you'll not be thinking it is overbought, oversold. You just say, since it's overbought, I will sell. Since it's oversold, I will buy. And that one, like I said, it's not efficient. But now that we already know what we want to do, oh, I came here because I'm looking for opportunities to sell. Why? Because there's currently political uncertainties in France that is affecting the euro. So now when I get to the chart and I put up the stock, my entry for a sell would come from overbought region, showing that whatever element of retracement or any buying pressure that must be showing on the chart at the time is already weakening and there will be room for prices to go lower. That's my entry point. But also, if I have taken my sell from that overbought region, I must start thinking about exit when the same stock enters into oversold region. That's what we are trying to say. That we're not just bothered about, oh, is it overbought, oversold? No. That we are bothered about, okay, we already know what we want to do, one. Two, we already know that in line with what we intend to do, if I was coming to buy, I would only be buying when my stock is in oversold region, suggesting that there's room for prices to rise. And I'll be looking to exit my trade once it gets into, the overbought region. But because I'm here to sell, my entries will come from overbought, and then exits will be coming around oversold. That's the idea. So we're not trading because it is overbought. We're not trading because it is oversold. We've decided what to do. We're just choosing the right place for what we want to do. Number three, because we have decided to sell from overbought region on the stock, and we understand, I mentioned this earlier, that overbought does not necessarily mean sell. It says, because we have decided to sell from overbought region on the stock, and we understand that overbought does not necessarily mean sell, we have to wait for entry confirmation. Listen to this. It says, because we have decided to sell from the information that we have, you can see the transition. The information we have is the one saying we should sell. And we understand that logically, it makes sense for us to sell when prices get into overbought, either from retracement or whatever is happening, and look to exit it when it gets to oversold. But because we now have the understanding that if we want to sell and we want to sell for oversold, some overbought region, and we also understand that typically oversold or overbought does not necessarily mean go and take a sell, we have to wait for entry confirmation. And what is the entry confirmation for a sell? It says the main line on the stock must cross below the signal line. This is where we are going to. See the transitioning of ideas. See the transitioning now. Right? Going from deciding what to do to knowing where the entry should come from based on just logical reasoning, to understanding that the fact that it is at the logical point does not necessarily mean you should go ahead, but then waiting for the stock for confirmation is the most important thing to do. You can see. So we decided we want to buy, so we want to sell. We know that the sell should come from overbought, so overbought region, and the exit must come from oversold on the same stock. And we also understand that because we want to sell from overbought region on the stock, and we also understand that overbought does not necessarily mean sell, we have to wait for entry confirmation. And what exactly is the entry confirmation? The main line, which is the thick one, the one that is not broken, going below the broken ones. If you look at all of the sell that we had, look at this strong sell here. The broken line, sorry, the strong line came below the broken line. See, it moved below it. You can see it was below it from this beginning here till the end here. You can see even the strong selling we saw somewhere around here. We also saw the blue line cross below the broken line. Even in this same sell here, the big line or the normal line crossed below the broken line. So it means the signal for a sell appropriately from an overbought region is simply for the main line to cross below the signal line. That's the idea. Now, if it was going to be for a buy, we can reverse it, right? If it's going to be for a buy, let me see if I have a buyer's market, in the market right now. Maybe USD JPY can cut it for a buyer's market. Now, for a buyer's market, we're changing this now. This is a buyer's market. So you intend to buy because JPY is weakened by the advent of a dovish prime minister. Which means ordinarily we're interested in buying USD JPY. And it says your entry for a buy now would come from where? We have to come from oversold region, right? Which means off any levels of pullbacks or any major downside you can see on the stock, you'll be looking to trade, to exit the trade when it approaches what? This time overbought. Just a reverse of everything we wrote for the first one, right? It now says because we've decided to buy from oversold region on the stock, and we understand that oversold does not necessarily mean buy. We have to what? Wait for entry confirmation. And the main line on the stock must cross above the signal line, above. And this one is not looking too good for the stock because prices are so high and it is still line high. Let me see if gold will fit this particular example. Let me see what's happening on gold. This one is so high. The market also, though we saw some strong buying off some levels, but it's not as straightforward as I expect it to be. Let me see if gold has something better. Also because gold has had like straight line buying with little retracements on the board, but we still saw that there were some elements of, connection somewhere here. Look at this one here with what we saw somewhere around here as well. After this particular move to this point, you can see that after this move back to oversold, the market still bought gold by over 200 something pips. We mentioned this on the VTF. We wanted to buy off a break and retest of this particular level, right? And prices went up. This is not less than how many pips here? This was about almost 300 pips to the top from this particular point right here from this same oversold region, prices rising, right? And you would also notice that the main line crossed above the signal line. You can see the main line crossed above the signal line, which is the confirmation here. So we pay attention to that. Okay. So in essence, if we're going to use the stock for, trade continuation, 4 things must happen. Number 1, you must know the direction you want to trade from market information or what you know about the asset. Number 2, you must understand that if it's that you want to buy, your buy should come naturally from oversold region on the stock, subjected to confirmation. If you want to sell, your sell trades must come from oversold region also subjected to confirmation, but you could also use it for entry and exit, which means if you're buying from oversold, look to exit from overbought. If you're selling from overbought, look to exit from oversold. But also remember not to trade simply based on what the stock is saying, but paying attention to also what you understand about the market first. Are we still together? And finally, before we look, we're going to talk about how it now helps us with what we call trade reversals. Now, the way stock helps with trade reversals is through what we call, a divergence. We call it a divergence, a stock divergence. Stock divergence. Stock divergence. And it's not compulsory, it is everywhere. Only when you spot it, right? Stock divergence for spotting reversals. What this means is, what divergence means, the divergence means when the market, in market price, and stock does not, and the stock report or chart, the stock chart does not agree. That is, this is important for you to understand what we're talking about. When prices are pushing higher and stock is moving lower or slowing down, that's a divergence. And vice versa. It means when the market and stock is not saying the same thing. It says divergence simply means, it means when the market at its price and stock chart does not agree. Market is consistently pushing to the top, but then your stock is showing market going down. That's what you call a divergence. That is, on your chart, you can clearly see market is going up, but stock is starting to move lower. That's a divergence, and it is a potential sign of a trade reversal. We have two types of divergences on stock. We have the bullish divergence and the bearish divergence. And this is what it is. Just going to write it out for you and see if I can spot anything like that anywhere on the screen. That's what we call a bullish divergence. When prices because it's a reversal. When prices are moving lower or stretching, let's just use lower. Let's just add more English. When prices are moving lower and stock is seemingly moving higher, we have a bullish divergence. That might be signaling that buyers would soon take over from sellers. I'll just explain both of them before I just write it out before I explain it. Then it means your bearish divergence is when prices this time are moving higher, because for something to reverse, it means it was going somewhere before and it wants to turn back. So that's why we're saying opposite things. When prices now are moving higher and stock is seemingly moving lower, we have a bearish divergence that might be signaling that sellers would soon take over from buyers. Now, the reason why we're using might is because it's not sure. The fact that there is a divergence does not mean that it is compulsory for the market to, reverse a particular move. No. But a divergence simply means when the chart and stock are not doing the same thing. Market is rising, stock is falling, or market is falling and stock is rising. When there's a difference or a disparity in what those two things are doing, we call it a divergence. And that divergence can potentially give birth to a trade reversal. In what sense? There will be a bullish reversal, which means there will be a situation where from a downtrend, market can potentially move back to an uptrend if prices are going down and stock is now suddenly showing a movement back up. That's a difference, or that's a disparity that is clearly showing that there's possibility that buyers will soon take over that particular market. Or if markets are consistently moving higher and is still moving higher, and instead of stock to also be showing you up, stock is now showing you a movement lower, going into oversold region, which means there's already a disconnection somewhere. When that happens, it is also known as a bearish divergence, which could be a signal of the signs that the market could potentially be turning lower soon, and that sellers might be taking over from buyers, as the case may be. Now, if you look at gold, for example, gold has a stretch higher. And then yesterday, to a certain extent, we saw a very big move lower of about 1,200 pips. The question is, if you look at all through when this move happened, there wasn't any reversal signal. For example, if you look at where we are, connect the dots here, market went up, stock went up. Then market dropped, stock dropped. Then market has gone back up a little bit, stock went up. Market dropped lower, stock dropped. Market has gone up, stock is also up. Market is turning lower now, stock is also turning lower. It means in this case, there's not been any divergence. So it means we're not seeing any reversal. Whatever downside we saw right now on gold prices yesterday is merely a retracement or a correction. It wasn't a reversal. We didn't see stock do anything against what price action was doing. It was entirely intact. It was doing exactly what price action was doing. It was leading the market, or at least in line with the market, with what the market was doing. So in this particular case, we never had any divergence that could suggest that the momentum has now shifted from being in favor of buyers to now being in favor of sellers. No, this particular market is still very much in favor of buyers. No divergence. No divergence. I think we also saw a nice downtrend on Euro USD. Let's go and see if there's any reason to expect a reversal. Even given the fact that the market is already struggling, after we've sold for a while, we've been selling since maybe 1st of October, pressure has been down, and we're seeing a range somewhere around here. Let us see if there is a, what's it called, on stock. If there's a divergence on stock, for example. Let's see where we have from somewhere around here. Let's start from here. Let's start from somewhere here. Let's start from here as a support, and also mark that out somewhere around here, also on the stock as a support level, right? And if you look at this, small up again, but it also went down from the same point. We saw prices go down, also upside, which is okay. We saw prices go down very well, pushed lower a lot, which is fine. Prices went back up a little bit. This is prices also going back up. Prices is struggling, heading down a little bit as well. This is stock also going down. There's not been any divergence. What will be a divergence is a scenario where this market is creating a low somewhere here and stock goes back up. If stock was back up now and market is somewhere around here, we could say, there's likelihood of a reversal. What? So it means, for example, sorry for the break in transmission. It means, for example, if the fact that we know that market is actually very low, it's been going down for a long time. It has a nice downtrend, as the case may be, over a period of time. And then we are seeing it starting to struggle somewhere around here. You could think, does it mean that the market is about to turn? Unfortunately, the stock is saying, I don't know now, or I'm not agreeing to that right now, because there's no divergence right now on the stock. It would have made sense if stock is currently inside the 80 mark or currently on top. That would have been, the best thing for us to see and say, there's potentials of seeing a reversal on this market. But right now, we don't have any potential of a reversal. The market is still saying it's a bearish market until maybe market story changes what is happening on this board. I think there's also selling pressure on on pounds USD. Let's see if there's any reason, if there is any call for reversal. Well, there's no call because market is on the ground. Stock is also under, oversold. It's not saying there's going to be any reversal right now. There's no divergence on this particular asset. So, and also, guys, you cannot go from chart to chart looking for divergences because you're looking for a reversal. Most times you will be able to get more moves from this guy if you trade it in terms of continuation. You want to sell, use it for major sell opportunities. You want to buy, use it for major buy opportunities. On days where you spot a divergence, where market is going up but stock is going down, or market is going down and stock is going up, on the days where they present themselves, good news. There's potentiality of us having a reversal in the market. Like I said, most of these tools, they work better when you combine them with what makes them make sense. Not just, I'm trading overbought, I'm trading over. So in all of the things we've discussed today, the major benchmark is this is an oscillator that measures the strength or weakness of a momentum, but to a certain extent, because it shows it in the form of overbought, oversold, we understand that this overbought, oversold does not necessarily mean jump into the market for either buy or sell, but rather what we try to do is bring the human factor, know what we want to do if we want to buy, if we want to sell. Two, we then ask the stock to help us with entry in the sense where if we want to sell, we want to sell from oversold region, overbought region. If we want to buy from overbought region, and then use the opposite level for exit, which means if I'm buying from oversold, I'm exiting out of overbought. If I'm selling from overbought, I'm exiting from oversold. But also because we understand that this overbought, oversold is not necessarily a trigger for us to take a sell, we await confirmation. And what is the confirmation? You wait for the main line to cross above the signal line for a buy trade, and you wait for the main line to cross below the signal line for a sell trade. But like we also said, that stock also could also offer reversals, but not every time, not always, not common, not like every time you see a reversal, but it can also do that. It can do that through what we call a divergence. In the case where the market is moving in a particular direction and stock is moving opposite it. If market is buying or rising consistently, but you are seeing stock go down, it's clearly saying that the strength of that uptrend or that up movement is weakening and is about to be a potential reversal on that particular move. Or if you see prices consistently going down and we see stock going up, it's also saying there is also, an issue with whatever strength that downside is also having. There's also a very strong potential of the market reversing that particular move as well. And don't forget that we mentioned, some of the brackets to which you can use stock on multiple time frames. We mentioned that the lower time frame, M1 to M15, 21.99 is the most preferred one, although you can use 14.55 as well. But according to industry standard, they feel like the best is 21.99 for those who are going to be using it to scalp. If you're going to be using it for major sentiments or trading normal market information, day-to-day activities on M30, H1, H4, the 14.33 is said to be an industry standard. If you're going to be trading higher time frame, in the market, I think it is the 9 55 or thereabout that you use, for that particular, no, I think 933 that you use for that particular regard as well on the board. This particular video is going to be up on YouTube for you to catch, later today. We spent above an hour already on the live, but if you have a question or something you want me to clarify, please put it in the chat box right now. I'm going to see what is happening there. Okay, there's moving here. Thank you. You're welcome, Lucky. What is the best time frame? Like I said, if there was a best, I would have said there's a best, which is why we distributed it into three: the lower time frame, the middle time frame, the medium ones, and the higher time frame. So whichever trading you do, either you're a scalper or a day trader, intraday trader, that should determine which of the time frames you're going to be able to use. Like I said, the two main and signal lines are here on the screen. Once you pull up a stock on your screen under oscillators, if you put up a stock and you put the parameters you want, the 1433, because this is M30, H1 or H4, whatever level you're using it on, there's a color part that gives you the main and the signal line. So the main line is the green one, the red line is the signal line. So that is what we're saying. If the green line moves above the red, that is the main line going above the red, that's a bullish confirmation trade for a buy. If the main line, which is the green, goes below the red line, that's a bearish confirmation trade for yourself. But you can use whatever color you want. The ball is in your court. Does it work on all pairs? Yes. It does not choose pairs. It does not choose pairs. It does not choose pairs. Okay, like I said, guys, we're going to have a recording of this up on the Telegram channel, on the YouTube page for you to watch again, get a good understanding of what it is that we talk about. But remember, guys, like I would always say, every tool works better when you had the human factor, the information aspect, and what you know about that particular instrument in the market. Thank you for joining the session today, guys. It was a pleasure coming live to you again today. Thank you for your time. We'll see you again next week when we are live again for another webinar. Thank you for your time. Good afternoon.